Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
Just fine, Andrew, just fine. How are you?
Good, good, good. We're getting ready for to head to New York. Myself, Bilal, and Andrew Lofthouse to see clients, see our professional clients. For anyone who would like to see us, please feel free to reach out. I know it's a bit short notice. Guess people will be seeing this on Sunday evening. We'll also probably be around for drinks after work, so feel free to hit us up on email or Bloomberg. So, as
Ah,
we always like to do, let's kind of dive into the past week. Just looking at kind of Bloomberg myself, I was just saying, like, wow, we've seen some pretty volatile fixed income markets, not just in the US, but in Europe, I guess, as well, past couple of days. Yeah, what's been your takeaway on the past week or so?
okay. So, big picture, I think the economy can tolerate 10-year yields at 4.5%. I've done some research on public debt dynamics, and in the past, up to QE, you had 10 years above nominal GDP and very good, very sustained growth. And that changed with QE, but we could be transitioning to a higher inflation regime without QE. So long story short, I think the market could be a little too nervous here, but it will take time to see if that is the case. In terms of the sort of news last week, um, so let's do a usual review in terms
Right.
of Fed. I thought the more interesting story was actually not about Fed speakers themselves, because basically we had the hawks being hawkish, like Bauman, Kashkari, and the doves being dovish, Goolsby, for instance. But the more interesting story was about the market expecting Powell to address the tightening of financial conditions. And of course, Powell did no such thing. He's learned not to target short run changes in financial conditions. More broadly speaking, I would say the Fed put is no longer, because we have high inflation. The Fed put was basically the fact that QE works by lifting risk asset prices. This is a portfolio balance model. No more QE because we have high inflation, so no more Fed put. So I don't think we should expect the Fed to come in and soothe markets, especially as long as there are no systemic threats to financial stability. Look at banks, how stable they are, of course, with a good dollop of Fed liquidity, but that's working. So to me, that was a more interesting Fed development of the week, the market expecting Powell to speak up and Powell just ignoring the market. This week, so for the data, we have NFP, of course, and
Okay.
for once, I
Okay.
agree.
Sorry. Can I ask one
Yep.
question?
Oh,
I was reading that the CEO of Citibank is now getting concerned that, say, lowest rated by FICO um, credit, I guess, grouping, she's starting to see that those consumers are struggling. And because a lot of times we talk about the fact, obviously, there's high inflation. A lot of times it's hitting the poorest, especially when it's things like food and energy. Um, but they're also getting, or they have been benefiting the last maybe 2 or 3 years from significantly higher wages, certainly a percentage basis. Uh, do you see that being a drag? I mean, obviously, we have other drags like the student debt and government shutdown, things like that. But do you see an impairment from, say, the bottom 25% in the US starting to struggle, or not really from the data you look at?
more the bottom 10% than
Okay.
25%. And also, remember, where do banks get their spread in terms of consumer lending? From largely from credit card balances, who borrows on credit card. I mean, the low income, low wealth
Right. Super high rates.
customers that Miss Fraser is worried about. So she can't have it both way, raise the rates on credit card and expect that there won't be an increase in delinquency. And I'd say delinquencies had been below average because of all the government support during the pandemic, and now we're just going back to business as usual. And on aggregate, the balance sheet of the US consumer is still
So pretty
strong.
strong. Okay.
Yeah.
Awesome. Awesome. And I guess it is what it is, like the volatility you've seen in the bond market. You don't see anything new. There's no like new things that you're worried about or not worried about.
No, I mean, Mustafa has been talking about long-term factors such as supply for quite some time. In terms of inflation, my view hasn't gotten worse. It was never great in the first place. No, I think we could. I mean, there is a story. There could be a story there, but we don't have enough data to be. I don't have enough data to be positive about it. Which is the story is that the Fed keeps putting 2.5% as its long-term Fed funds rate, which means it thinks it can go back to the benign, very low inflation environment before the pandemic. I don't think that's realistic. It could be that the markets are shifting their view on what inflation looks like, I don't know, 4 or 5 years down the road. And that could be one of the reasons why yields are moving. But honestly, it's hard to tell at this stage.
Yeah, it's a couple of days. And last question before we move to the upcoming week. The University of Michigan 1 year inflation um numbers that like do you see anything in I
So
guess it's holding constant around 3 or 3 points.
exactly. The University of Michigan inflation numbers puzzle me, just like the small wage growth puzzle me. Maybe the two are related, but you know what they say? You can fool some of the people some of the time. You can't fool all of the people all of the time. So if inflation continues to be above expectations, eventually expectations are going to move to actual inflation. I mean, this is what adaptive expectation are supposed to be about eventually. But I have to say, I am very puzzled. What could be happening is that we are in a period of transition. We've had another week of oil prices above $90 a barrel. Gas prices are going up. So perhaps we have to wait for next month or even the month after to see 1 year inflation expectations move up.
Yeah, it's rising.
They are typically quite correlated with gas
Right.
prices.
Right. Okay, cool. And sorry, as you were about to dive in for this upcoming week, some interesting data points. So, yeah, what are you focused on? Whether data or obviously government and Fed.
So NFP, which I'm assuming is going to get released, even though the shutdown is unlikely to be over by Friday. And for once, the consensus seems reasonable to me. I mean, 170K increase, a bit of an acceleration in wage growth and a decline in unemployment. So not much change in the broad picture of a labor market that remains still very tense. So that's one. Then we'll have the PMIs. I mean, this is the beginning of the month. I think the market consensus could be a bit too pessimistic there because if you look at other surveys, for instance, the small business surveys, or even if you look at the S&P PMIs, the ones we are getting next week are the ISM, you see the beginning of an uptrend since the first quarter. So the consensus has manufacturing moving sideways and services falling by 1 point. I think this could be too negative, but I mean, not in the big grand scheme of things, not a super big thing. Then we we have the jolts, and you know what I think about the jolts? Not much. And I am pleased to report that the news media are finally agreeing with me and saying that job openings are overstated. But never mind, the Fed looks at the ratio of a job opening per unemployed. That ratio is falling. I think it's a little distorted. I prefer the ratio of actual hires to job opening, which is also going up, which is another sign that the labor market is normalizing. We're moving back to balance. So I'll be commenting on this, though honestly, I don't think it will be a big shock. And I think that's about it. I mean, that's for the main indicators. The big question next week is, of course, going to be the shutdown. My expectation is that it could take about a week to 10 days. That's my base case scenario before the Republicans agree among themselves.
You have an idea what you think that agreement would like encompass?
Sure. So additional border security measures, which is meaningless basically, because I mean it's not clear what extra money will do, what extra rules will do. It is such a huge and complex problem. A little bit of a cut in non-military mandatory spending, compromise on funding to Ukraine. So I'm thinking about 10 days, a week to 10 days, because just looking at past shutdown, the worst was under President Trump, 30 days or so. And basically because the president and Congress were on two opposite sides of the border wall, with neither side prepared to budge. I think this time around, the reason for the shutdown is basically hard-right Republicans who want to throw their weight around and create, problem just
Yeah.
to show they can. Yeah, there is a risk the shutdown could last longer.
Yeah, I saw your research, which I think you have a good point.
Yeah, I mean,
Like
basically,
the smell test is like, I'm not sure that Biden, like the Republicans come out so bad against this.
well, that's it. I
Yeah.
mean, under Clinton and under Trump, I think the shutdown really hurt the Republicans. But now you're seeing polls, one which was very interesting. Americans basically, I think 30% of Americans think that neither party is responsible, but they are fed up. And in terms of, attributing the blame to each party, it's quite balanced. And so if that is the case, my view is that the shutdown could actually increase support for third-party candidates that are likely to hit Biden's prospect much more than Trump. So if this view is correct, and it turns out that the shutdown is actually hurting the Democrat, it could last much longer than I expect. But we
Yeah.
will see. We'll get to
Good
sense
point.
next week.
It's I forget what's the one of the ones no what's it called?
No labels.
No, it was like I forget, they had a few governors, they had a few
It's a centrist party.
no labels, you said.
Yeah,
Yeah,
no
so,
labels.
sorry, there's yes. So a friend of mine was a donor to them, and a couple maybe 2-3 years ago I went to an event with him. But yeah, it more the vibe I got was it more was would eat into Democrats, like it's kind of like a more social liberal and more conservative financial, which I think a lot of Democrats probably would agree with some of that stuff. So, but it's still hard for all these, just because of the nature of the electoral system. It's still, my understanding is it's still quite hard for them to have a real impact.
Sure.
But considering that if it's Biden and Trump, they're both significantly, not me, making a judgment, but pretty standard view, they're both significantly flawed characters and candidates.
Well,
Uh,
and if you look at the polls, they are neck in neck. And in fact, if you look at betting odds, the odds of Trump win have now gone above those of a Biden win. So you don't need a lot, I think, to push Biden. I mean, for Biden to lose. And even
right.
if those third party votes, if they get only a few
Yeah, they get
electoral,
2%,
yeah.
and they'll probably get less of it in New York and California, and they'll more get it in Midwest, South, Southeast, where West, where it could be more, silly question I want to ask on this best forum, but
Ah,
not like I love him, but who would poll better against Trump, Biden or Gavin Newsom?
I think okay, so objectively, without my
Come on, you
express,
live in California. I just remember.
I think Newsom for sure, because one, he's more alert than President Biden, so he doesn't have the age and the cognitive issues. He's very photogenic. He's a perfect for an American politician, and
You're
I
in
think
California.
exactly, he would change. He would tone down his very liberal policy. He would move to the center.
Yep. Yeah, I mean, I can't think of it. I mean, I heard some people even say, I'm assuming he would run as a Democrat, like Jeff Bezos, but again, these
Jeff
guys, that kind of money and power, like, why would they?
and he stand no chance. Look at what happened to Mike Bloomberg. He had a lot of good ideas, but he was not a
And
politician.
and he actually held office. I mean, he was a twice elected in two different parties in New York. Yeah.
No, I think people are looking for a third party candidate. If I have one prediction about this election, we're going to see the biggest share of vote ever going to third party candidates because Americans, I think 70% of Americans do not want a Biden Trump rematch.
Well, we'll see. I along with Bilal and Lofty will be in New York next week, so we'll probably get a good litmus test. Or we'll ask the questions with our clients. So, okay, awesome. Anything else for?
No, that's about it. I'm hoping we'll get, the data for most of the week, despite the shutdown.
Right. Exactly. That would help. So as we always like to do, I'm just looking through, uh, and also always a lot of stuff comes out on Friday. So certainly for our professional clients, as always, I would recommend Bilal's Macroscope as 10 macro charts for Q4. Caroline continues to break down across SEMEA. So looking at Poland, she also did a great piece on Israel earlier in the week. Mirza and Liang Ding, who's now one of our researchers based in China, have been continuing to update and improve the China growth tracker, which is actually showing surprising picking up in some activity, which is clearly against kind of most people's views. So definitely worth diving back in, looking at, reading that research piece and kind of at least short-term thinking about how that may impact people's positions and views. Ben Ford, who's had some fantastic calls and kind of the dollar block and Scandi, is looking at if we did see a bit of a pullback in the strength of the dollar, which medium longer term we continue to believe in. These would be some trades that we like, including going long Euro Stocky and also short Kiwi. Super interesting trade. I know Varesh and Mirza have been talking about this trade for more than a week, but we finally got around to being able to put the piece out about higher rates and the impact on, what partly is a strong dollar, but really kind of pretty large negative carry now with how high US interest rates are for gold to overcome, and how we can see a significant further correction in gold or sell off, which is exactly what we've been seeing today. So that's great timing. The rates weekly, tons of great stuff as we always do. So yeah, thank you, Dominique. Thank you as always to all our clients, as you always like to say, Dominique, all the great feedback. We've gotten I can say we've gotten some amazing positive feedback on you and all the team the past couple of weeks, particularly around the bullish dollar views, pounding the table, and also on the sell off in the long end in U.S. Treasuries. I mean, those basically our two core views have worked really well. But there's always stuff we can do better. We're continuing to work on these additional products around FX and interest rate derivatives and on inflation economic forecasting tools. Um, both those things I think will be launched through a dashboard format in the next couple of weeks. So anyone has interest in that, please reach out to me, and wish everyone a great week ahead.
Likewise, and an epic roadshow in New York. I'm sure you'll turn the table on the elections.
Great. I'm not sure which way I want it, but probably away from those two. So, okay, cool. Awesome. Thanks. Bye.
Bye.